Brett, what does all of the weekend's activities and into this week, and we're waiting on statements, we're waiting on more statements, what does it mean for volatility in markets, not just equity markets, but beyond?
Yeah, so listen, I think that both the guests that were on before are talking about things calming down a little bit. So whenever you have these tensions at such high levels, there's a great, there's some real, the challenge is to calm the markets and to calm everybody's positioning right now. I think that Iran's been very clear about that this was a one-time thing, and if Israel keeps levels where they are, I think we can reach that calm. Oil's certainly telling us that we're there. I mean, oil would be trading much higher if the markets thought that this was going to get further along. I think one of the interesting points to bring in here maybe is that you used the war in the shadows. Iran bringing this to the head right now maybe is what this conflict needs for everyone to take another look at it and say, what are we doing here? And take a step back, and maybe we can have calmer heads prevail in even, in Gaza and Israel.
Well, that sort of depends on what happens next in terms of any new kind of invasion of Rafah and how the Arab world reacts to that as well, right? Brett, would you change your positioning here in any way, given that the market has been pretty sanguine about geopolitical risk? Many commentators say that, and yet geopolitical risk is clearly a daily thing.
Yeah, so it's here to stay. I think everybody, there's a certain dose of it in everything that everyone's looking at. I would say that continued geopolitical tensions unfortunately revert back to the safety trade, and the safety trade seems to be money into mega cap U.S. names. You see Asia's trading off today, Japan's trading off. Regionally, you probably get some calm, but whenever there's conflict, people look to the safe names, and the safety net seems to continue to be the big cap names in the U.S. I think everyone would like to see that change a little bit and see the rally broaden out and go back into Asia and to Europe. I just don't think it's happening right now.
Before all of this happened, we had a very strange week in U.S. stocks last week and trading. We got inflation data that was hotter than anticipated. We got, maybe signs that the Fed can't move as early as it would have in other circumstances. And then, of course, we also had some bank earnings that really threw the market off on Friday. How would you respond to all of that this week if we hadn't had everything that's happened in between?
So we'll make the decision pre-Friday. So all the stuff that's happening pre-Friday, you and I were talking before we went on. I think that's actually gotten kind of silly, and I'm using the word silly with the Fed because they're using words like silly, they're using sticky, they're using for longer. These are not institutional words. They're not words that analysts use. I think the Fed has gotten very emotional, and the Fed has proven that they're always behind the curve.
Sticky inflation is a thing, though, right? People talk about it. It's economists use it.
Yeah, but let's remember where we started. It was transitory for a long period of time. Transitory is a little bit more institutional, I think, than sticky. My thought is just that it's emotional. We're going into the election. The Fed should be getting what they need to get done now. They shouldn't be pushing it out into September. You have the election in November. It gets highly politicized at that point. I just don't see why they can't see and read some of the tea leaves that this is the time to be acting. China's helicopter moneying in. There's no way the two biggest economies have conflicting monetary policies.
You're saying the Fed should just cut and get started?
Yes.
But the data doesn't back that up. The labor market is extraordinarily strong, and it might just feed more inflation.
Yeah, so I think they are data-driven to a point, but I think they're slow to react. If you look at what they did prior to raising all the rates, they should have been raising earlier. So I just, they have this course of action that's like threading the needle. And I just don't understand what the benefit of that is. They need to cut rates. If you look at the two largest economies, being China and the U.S., they are on diametrically opposing monetary policies. How long can that happen? How long do they stay in those ways? There's no way that the two largest economies in the world are that different and not codependent.
Given how you feel, that you think policy is incorrect in the United States right now, what does that make you do with your money? Are you all cash?
No, look, it's all in mega cap. That's where the money hides right now because it's a great proxy. You're getting global growth. These names are everywhere. They're easy to get in and out of. There's huge liquidity pools. But that trade is defensive in nature. So like I said, I'd love to see this rally broaden out and have some new names brought to the fold and get more into Asia, spill over into the Middle East, into Europe. It's just not happening right now because people are confused, and uncertainty breeds this defensive behavior. And that's what we're seeing from money managers.